Business, Australia's business channel. The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Good evening and welcome to Your Money, Your Call, and this is our special edition where I'm joined by 5 of our top experts to answer your questions in front of a live studio audience. Now, joining me tonight is Lisa Montgomery from Lisa Knows Money, Andrew Wilson from the Domain Group, Michael Teys from Block Strata, Brad Beer from BMT and Ian Rodrigues from Bishop Collins. So you can see we have a fabulous lineup of people all standing by to take questions from our live audience. Now, unfortunately, you won't be able to call in tonight with your questions, so sit back, relax, and please enjoy the show for tonight. And we're going to go to our first studio audience member with their question. And our first person this evening asking us a question is Cassie. Cassie, would you like to stand up and ask us your question, please?
Hi guys, so I'm looking to invest in a property.
Sorry, can we just do that again with you? You'll have to wait for the... Yeah.
So I'm looking to invest in the property market for the first time, and I'm interested in some of the strategies that you guys would employ to draw wealth from the property market throughout your life, as opposed to maybe planning for retirement.
Okay, so the question from Cassie, and she spoke to me just before saying that she's not really wanting to wait until retirement to get her money out. She wonders whether it's worthwhile investing now with a view to actually accessing that money a little earlier than that. So we might start with you, Ian, on that one.
Sure. It's a good question, Cassie. One of the key things when you're looking at each investment is to decide what structure to put it in. So, of course, one of the things we talked about is superannuation. And, of course, assets and money inside superannuation are trapped in there until you actually retire, generally for most people after age 60. So there's a lot of time between now and 60, and there's a lot of investing to be done outside of super. Not to say you just do it all one way or all the other way, but there's a balance to be struck. When you come down to your choices today, in your own name, in a trust, possibly in a company, might be the way to go. But I think it really is about setting what your goals are, understanding what that might look like over the next few years, whether you need to access equity that you gain in these properties, how you're going to structure loans. They're all issues you're going to need to consider. So I think there's a lot of work to be done, but it's a very exciting journey to go on as well.
Lisa, I guess one of the things that Cassie's probably going to have to think about is how she structures her loans, but also debt repayment is going to be a real key for her.
Yes, it is actually. Cassie, you know, one of the things I think it's really important for you to do is, as Ian says, is to actually set some goals, get a strategy in place. And one of the things that I would recommend is that you set that time period in your life where you want to be in receipt of this income, and then work back from that in relation to the number of properties that you want to accumulate to get you that income. You do need to look at how you structure your loans. It's really important, and I think that it's probably a good time for you to start that investigation stage with a lender or a number of lenders to look at what you can borrow now, what your current deposit situation is in relation to your income, what you're looking also to do with other areas of your life, so that the commitment you make today is going to actually complement that as well.
Good question, Cassie, and it's great to get started, but I would just add to that by saying one of the things that young people always want to do is get into their own home, and many of them really struggle to put together a deposit for that. There's a couple of things that you can think about, and one of them could even be investing as an investor first and build an investment portfolio. That way you don't quite, and you're here in Sydney, you don't have that reliance on simply trying to save for that big house that's going to be costly for you here in Sydney. Instead, you might become a landlord first. And you can actually become a landlord of many properties, and as long as you never live in any of them, you can still even access that first home buyer's grant when the time comes for you to buy your first home to live in. So, you know, there's a lot of really positive things out there for you that you can look into. Well, look, let's go to another one of our questions here, and this is a written question, and it's for you, Brad. And Alicia asks, can you get split depreciation schedules as easily for tenants in common as you can for joint tenants?
Simple answer, yes, you can. Whether they're split, whichever way they're actually split, it's all pretty much the same for us. It's whether it's just a percentage issue, and we'll split them up however we need to split them up. Yes.
Excellent. Thank you for that. All right, let's go to another one of our studio audience members now for their question, and this one is Amanda. And Amanda, I believe that you have a question about Logan. If you'd like to stand up and ask that of the panel, please.
Yes, I'm interested in investing in the Brisbane market specifically, and as I've been looking at some of the statistics on the Logan Shire, it looks really strong. There's short number of days on the market, the rental yield's strong, and the vacancy rate's low. However, we haven't seen any growth last year, and I'm wondering if we are going to see it into this year.
This is probably a good one for you, Andrew. I know that Brisbane is one of those markets that a lot of the experts are picking. Certainly the northern suburbs and the southern suburbs are pretty strong in that family demographic we always talk about. What do you think of that whole southeast corridor?
Well, certainly Brisbane's in pick-up mode at the moment. Prices growth last year around about 6%, similar to the year before. Probably about 6% again this year, but it is mainly middle and upper price ranges that have been activated, and that's that value perception that it's a good time to buy because prices have been flat in that market over the last 3 or 4 years. The outer suburbs have struggled a little bit. A lot to do with the economic performance there, concerns over job security. I think areas such as Logan and Ipswich and out to Moreton Bay to the north really have been underperformers, but they certainly represent good value if you want to take a longer term view of the market. Now, I think Brisbane's going to be a trickle-down market in the sense that the upper price levels will work their way into the lower price levels. It usually works the other way around, particularly given lower interest rates and maybe some better signs about the economy there. But Logan hasn't grown. With Ipswich, it's been an underperformer, and Moreton Bay, probably because a lot of listings, a lot of stock on market there have kept a bit of a balance between supply and demand in favour of buyers rather than sellers. So if you're looking at Logan, medium, longer term view, but certainly good buying at the moment because it's value in terms of it hasn't had a lot of price growth over the last 3 or 4 years. Does that make sense?
Michael, I might get you to just tip in there as well because you're from that area and we've seen big changes in Logan already. Certainly the recipient of big infrastructure projects, transport, logistics, a whole lot of things. And I understand there's also a fair amount of international investment into Logan as well in the commercial sector. What do you see happening up there?
Look, that area has always been a darling of the investors because of the juxtaposition between the Gold Coast and Brisbane. So it's bang smack, for people that don't know that area, it's bang smack between them. There's a very good road between it, which is good for industry. My family has an abattoir in Beenleigh. We kill cows, and we employ about 1,000 people there. And so there's plenty of employment in and around there. It's often overlooked by people from Queensland because some of the Logan people have a bit of a prejudice about.
Come on, they call it Bogan.
They call it Bogan,
like,
yeah.
Let's just tell it like it is.
And you go shopping at the Bogan Dome. But I forgot we're on television. But people have a bit of a prejudice about it. But it's not fair. It's a great place to live, and there's lots of families there that are doing very well. And the property there, I think, has a great future.
Amanda, I've had the great pleasure of speaking to the mayor there, Pam Parker, a couple of times. She's a dynamic woman. She certainly has very, very ambitious plans for the Logan area. And if you subscribe to the theory that if you shoot for the stars, you're going to hit the treetops, then Logan will definitely hit the treetops. I think what's happening at the moment is we've seen a lot of investors get into the market. When investors take over from homeowners, we get a bit of a glut of rentals for a while. while until that works its way out. But the population grows faster than the national average does there, and it's a very strong family demographic. So as Andrew has alluded, as a long-termer, it's one of those ones that I talked about today where we're looking at getting that generational growth through the whole area. I don't think there'll be a major boom, but I certainly think it's something that's worth hanging on to. Okay, look, we're going to go to, before we go to the break, we've got just time for one more of the written questions I have here. Now, I'm not sure which one of you are going to answer this, but it's certainly quite an interesting question. So I'm going to put it out to the whole 5 of you and see if anyone's game enough to step into this one. And this question comes from Jacob, and Jacob says, is the change of government in Queensland going to impact on the property market?
I'll have a go at that.
Okay, away you go.
Well, by and large, governments don't impact the bottom line more so than ever before, because I guess all governments are moving to a central position in terms of their policies. But the thing that does change is confidence, of course, and I think that we will see an improvement in Queensland, not because of the nature of the government, but just because it's a different government. And I think we're going to see a lot of changes of governments down the track in our political system going forward. And that, in the short term, particularly for Queensland, will hopefully mean a brightening up in terms of confidence. The economy's actually started to show some early signs of improving in Queensland, so maybe that Labor government's got in at the right time. But I don't think it's a policy differential. I just think it's a question of confidence and renewal and change that will drive it.
Ian, if we think back to New South Wales around about 6 years ago, we saw some government decisions that had a decided negative impact on the market, and that included the decision to bring in the vendor transfer duty, and it almost killed property dead in the water the moment it was introduced. They're the kinds of economic and policy decisions that can have an impact on the property market.
Yeah, I think if you subscribe to the view that governments are there to sort of, improve our lives and only step into markets where there's some type of market failure, which is sort of, lends to the idea of smaller government and only sort of stepping in where they need to. We've had a few governments where it feels like they've jumped in and they see the control room and start pressing buttons just to see what happens. Now, the vendor duty, you've got to question what on earth were they thinking?
Well, it's easy to know what they were thinking. They were thinking revenue raising, and, that's pretty much it.
The modelling must look at it and say, if we got 2% of all these transactions, we'd be rich, But it doesn't allow for the fact that if you bring in a tax that no other state has, no one's going to do business in your state. I think Andrew said this morning the New South Wales government are collecting the order of, $2 billion a year in stamp duty. In boom times. Put back in the vendor duty and you'll probably, do something like halve it. So it was one of those things where it drove a lot of investment out. And to be honest, that's, in my view, an example of bad government, is when they're making decisions that make investors' decisions completely skewed.
Yes, very quickly, Michael, because we've got to go to a break. But
I don't think there's any proposal, but at the moment, to introduce any such tax.
No.
And I'm also questioning your statement earlier today about the Labor Party being opposed to capital gains tax, 50% exemption. I've never heard of that. We've been looking all afternoon for it, and I'd really like to understand more about that. But I think, generally speaking, there's no proposal to radically reform the tax effects on property at the moment by either party.
Let's hope that all governments do take a little bit of a look at that stamp duty, though. It's quite high in Queensland, purchase stamp duty, so it would be certainly a good one to amend. Well, thank you for joining us tonight for our special edition of Your Money, Your Call, but we do have to take a break for a few important messages. We'll be right here when you come back with some more studio audience questions. Remember, you can't call in tonight, but do sit back and relax. Don't turn over to another channel. We'll be back very soon. Welcome back to Your Money, Your Call. If you've just tuned in, you won't know that tonight we have a special edition and we are with a live audience down here at Crow's Nest, and I have with me on the panel 5 of my best experts: Lisa Montgomery from Lisa Knows Money, Michael Teys from Block Strata, Andrew Wilson from Domain Group, Ian Rodrigues from Bishop Collins and Brad Beer from BMT. Now, you can't call in tonight, unfortunately, with your questions, but we have a great studio audience here asking some fabulous questions. So let's go to that next question right now. And I have Sandra. Sandra, where are you? Okay, over there to Sandra. And I think you've got a question about loan structures.
I do. Regarding financing property, can you explain further how it would work? I think Lisa mentioned it earlier. If you have several properties and having one loan for all of them, would that not be an accountant's nightmare? And especially if your principal place of residence might be mixed up there somewhere too?
I think what you're talking about is a structure which is called cross-collateralisation, and a lot of lenders, mainly the big four banks, will look at that as a structure that they prefer. And what it is taking a first mortgage over a number of properties and having those loans sit underneath one structure. And they like that because it gives them all of the security under one umbrella, but also it allows you to get every piece of equity out of there when you're looking to leverage into other property, because you've got that one structure, one arrangement which has all of your loans under it. Now, one thing which I think is really important is not to have one loan for all of your investment properties, and including your PPOR, because you don't, or your principal place of residence, because you don't want that wrapped up into one loan. This is one mortgage, but beneath it, what you want is a number of splits. So, for example, if you have 4 properties, 3 investment properties plus your home you live in, you will have 4 separate splits or loans that will sit under that one mortgage arrangement. And that way it's not an accountant's nightmare, because you can look at the variety of interest that's apportioned to each one of those, and you can also see which of those properties which are performing or whether they're not performing. So really, under that cross-collateralised structure, you want to have a variety of splits which does separate all of those properties from one another.
Ian, just to further comment on that, some people do have a single loan for all of their investments together. That's okay, but it does make it a little harder for you, doesn't it? Because you then need to apportion that interest into each property at tax time. Yeah, we can handle a calculator though, so it's not too bad. I think the key point is, as Lisa's made, is cross-collateralising is one issue. There's reasons why you would and there's reasons why you wouldn't. Generally speaking, you probably would, right, as a general comment. As long as the loans are all tax deductible, if it's one loan, it doesn't really matter. There is an apportionment exercise we'd need to do to allocate interest to each property. That's not too bad, but really if you go, like Lisa's saying, it's effectively like a sub-account. So $1 million facility, there might be 4 sub-accounts. It means that it's easy to apportion because it's already calculated for us. So that's an accountant's dream. So, and of course what it allows you to do is, if you do have a home loan component that is not tax deductible, you can of course direct your payments and pay downs of the loan quicker to get rid of your non-deductible debt. And that's probably the single biggest value add. And I would like to just make a comment on that strategy though. One of the things that you have to be particularly careful of if you are going to direct the greater portion of your loan payments and your rent payments to paying down your home loan, you still need to meet the interest bill on all of the investment properties. A couple of years ago, a strategy was introduced by a couple of spruikers whereby you paid all of your money into your home loan and you capitalised the interest on your investment loans. And then what happened, of course, was that your home loan got paid off very, very quickly and your investment loans grew, and so did your capacity to claim tax. So you had bigger and bigger tax deductions. The tax office does not like it. There's been several cases. They've won some, they've lost some, but the bottom line prognosis of that whole mess is that the tax office doesn't like it when you capitalise, and they've ruled against it in quite a number of cases. I guess the advice that I'm really giving to the viewers at home here is I wouldn't be doing anything like that unless I'd spoken to my accountant first to make sure that I'm on the right side of tax law and not on the wrong side. Let's go to another one of our written questions, and this is from a young couple who says, we are in a position to begin investing and would like to buy our first investment. What are the 3 key points for us to know in order for us to get started on the right track? You know, I'm going to start with you on this one, Brad, because I know you're a depreciation guy, but one of the things I like about having you on the panel is that you're also an investor with a big number of properties under your belt. You've made some mistakes, but you've gotten a lot right as well. What do you think some of the things are that a person needs to get right?
Interesting. I'd probably say that the first thing that you need to learn about is probably finding the right properties that are going to actually deliver the wealth over time. Part of that is being able to actually afford those properties. So you've really got to find out, well, what can I actually buy? I think a very, very, very important component is actually financing. I think learning how to finance properly, how to deal with finance, how to allow finance to help you take some of the risk away from property investing is very important, because being able to borrow enough money to cover some of the risk if something does go wrong is something that's... financing was something I learnt more about as I went through the journey, I suppose. And if I knew a lot more at the start, I would have probably made more money or more wealth out of those properties. Being careful not to get sucked into buying... Have I given you more than 3?
Yeah.
Being careful not to get sucked into buying things for the wrong reasons and taking the fundamentals of why you buy this property here for the future wealth are probably very important.
Andrew, I'm going to ask you, do you think it's really important for young people to get hold of all of that, or for anyone to get hold of that economic information that you're always talking about?
Oh, absolutely. And we showed some indicators that you can use to determine what is happening in housing markets. But I think the key thing from my perspective is to take that medium to longer term view. And we have millions of small investors in this country, and it really is part of the platform that drives our housing market. And as we saw today with that data, it showed that even when prices are falling, even at the trough point of our cycle, we still have around 36% of our market share with investors. Now that shows that it's not a get in, get out, quick type of picking winners scenario. And I think don't look to pick winners, look for stable, strong, particularly capital city markets and maybe strong regional markets. And forget about terms like hotspot and these types of scenarios. And I think this is what the majority of investors do in Australia, and that's why they're so successful, and that's why our housing markets are so successful. Resilience.
Sounds like some great advice there, and I will add to that by simply saying that, to me, the most important thing that anyone, when they're investing in anything, can do is to become educated before they make even a single step. It constantly amazes me how many people are out there investing in what is probably the biggest investment that they will ever have in their life, and yet they have no idea what they're doing. And when that happens, then you trust a whole lot of other people to make the decisions for you. The property industry is fraught with people who are in it just to make their own bottom lines probably better than yours. The only way that you can beat those people is to be educated in your own right before you even make any kind of move whatsoever. Let's go to another one of our audience questions. And Steve, where are you, Steve? You have right down the back there, if you'd like to stand up for us, you have a question about what questions you should be asking your owners.
Yes, thank you. The question I had was about, when I'm purchasing a property, is it worth asking the previous owner to share information such as the water certification, depreciation reports, schedule, and any other costs and details about renovations that have been made?
Okay, now I'm going to come to you first with this one, Michael, from the perspective of not just if it's a strata property you're buying, but I guess from a legal perspective, would you be worried about anything that the owner told you? Is there any kind of legal recourse that you could have to them? How much should you get a previous owner involved?
Look, there's a practical problem. Most agents won't allow you to get access to the owner because they're afraid that you'll actually exchange information and jeopardise the sale. I think what you got from that source is unreliable. It'll be biased. I have a saying in business that people behave the way they're paid. And in this transaction, the owner's taking your money. So the information that you really are seeking, you should be seeking through your solicitor or your strata inspector. You can do searches for all of these things and get the right information from the government departments. It's part of the process. So there shouldn't be a need to rely upon any information in terms of statutory charges and things. In terms of the property itself, perhaps Brad will have something to say about that in terms of renovations and that sort of thing, but I'm pretty sure he'll say he'd rather make an assessment anyway. So the short answer is no, I wouldn't bother talking, because I think the information should be discounted so heavily that it's just not worth bothering about.
Brad, now I could be wrong about this, but my understanding is that a depreciation schedule is attached to a person rather than necessarily a property?
It's attached to a person, but the property itself, you've still got the same construction cost if we estimated it from 10 years ago, 5 years ago. So some of the information is handy, but we're going to reassess that depreciation for you as a purchaser now to get the maximum deductions for you. Now, anything that's provided, we'll take into account and use it as part of preparing the report. As far as anything else regarding renovations, any information you can get, I mean, it can be handy, but relying on it's very difficult, because you know the person that's selling to you has a vested interest in getting the most money they can. Things to look out for in renovations, I suppose, is how long they've probably owned the property. Was it just bought and renovated? Because if so, their interest was probably not for them. So in renovations, it's really easy to cut corners, and you always find more stuff once you start renovating that costs a lot more money. Now, if you're an investor who's buying to resell quickly, you don't want to spend that money if you don't, if it's not a problem for you long term. As someone who's about to take that property on, it's more interesting to know that they've actually fixed it up properly, and so how long they've owned it, have they done that with that intention in mind to start with, is an interesting question for you to find out.
Brad, just one other thing, and I think this is what you were alluding to. When it comes to construction, then that's the same every year for 40 years, no matter who owns it. But when it comes to those fixtures and fittings, you actually personally get a new effective life because you've bought them at second-hand value, more or less. And sometimes that second-hand value, or the remaining, or the new effective life, can often be a little bit more than whatever's remaining in that other person's report.
Look, and it's not just around the effective life. We don't know if the previous owner was an investor, owner, occupier. What we don't know, we're putting like a second-hand market value and assessing those items to get the best depreciation for you as the purchaser of that property.
Fabulous. Well, this is Your Money, Your Call, and we're here in front of a live studio audience taking their questions. But we do have to go for another break. Don't go away. We will be back very soon to answer some more questions. Welcome back, and thanks for watching. With me tonight for this special edition of Your Money, Your Call, I have my top 5 property experts. Lisa Montgomery from Lisa Knows Money, Michael Teys from Block Strata, Andrew Wilson from Domain Group, Brad Beer from BMT, and Ian Rodrigues from Bishop Collins. As I said, we're here in front of a live audience, so you can't call in with your question tonight, but do sit back and relax and listen to the fabulous answers that my experts are providing to our audience this evening. And I'm going to go to you, Mandy. If you'd like to tell us what your question is, I believe you've got a question about strata.
Hi, I was just wondering, when you buy a residential house, the contract you would always state subject to pest and building inspection. When you buy a unit, as part of that contract, do you state subject to a strata inspection?
Michael.
Thanks, Mandy. Look, you could do that, but the vendor and the vendor's agent would probably not allow you to do that because it's such a subjective matter. The report will cover so many things that it's effectively a get out of jail free card, and so most vendors wouldn't allow you to do that. That said, it's really important that you get the report done, and the report may contain some issues that haven't been touched on in the negotiation, which would allow you to pull out or would result in your financier not giving you finance anyway under the contract. So there's probably protection there if the issue goes to the root of the contract, but you won't get away particularly if anyone's watching this show, you won't get away with such a rubbery clause to get out of the contract.
Look, I'd like to just clarify that a little bit for all of you who are here today, and certainly the home viewers. Every state in Australia has a different process for making an offer and for drawing up a contract, and it's important that before you begin buying property that you understand the differences. In New South Wales, there is no contract until you've done all of the things that you need to do, paid up your 10% and then exchanged your contracts, and under those conditions there's no getting out of that contract really for anything. It's let the buyer beware, and if you haven't done suitable strata report, inspection reports and suitable building reports, then you can't get out of that contract. But in other states, for example WA, your contract is actually a set of conditions that need to be satisfied before it becomes unconditional, and in that you can include subject to a strata inspection, subject to a pest inspection. And the thing about WA that makes them different is that that particular contract actually removes that property from the market and nobody else can buy it. Whereas in New South Wales, you're vulnerable until you get to that point where you've exchanged. Queensland is similar, particularly with the new laws, where you make your offers on a contract. Those offers have all the conditions that you need satisfied. Once those conditions are satisfied, or if the time runs out that you've allocated for satisfying those conditions, that contract either becomes conditional or unconditional, and if it's still conditional, then it can fall over. So I guess the more important question is, what things do I need to know about signing contracts? And very importantly, you need to be familiar with the contract process in the state that you're buying the property, because it's going to be different everywhere. Let's have a look at another written question, and this question is for Brad, but I'm sure that some of the others of you can also contribute to this, certainly you, Ian. And it says, if I lived in a property that is now, if I had a property that is now being rented, how does the pooling work? So if I lived in a property that was being rented, how does the low value pooling work on that? And the second part of the question is, how does depreciation affect capital gains tax? So we'll go to you, Brad, with that first question, and then Ian, I'll come to you with the capital gains tax question.
Low value pooling is an election, so you don't have to do it. You can decide not to do it. So when you decide to do it is really up to you. Providing you haven't low value pooled something in the past, then you must add new things under that entity to the low value pool. So if you've lived in the property, then you decide to do a decide to rent it out and use it as investment property, and then, you know what, I want to look at low value pooling some of my items. You're allowed to make an election to do that at a later date. And I think the capital gains tax, we're going to go to Ian.
Yeah, Ian, so you know, the question was, these people lived in a property, it's now being rented out, and their question is, what happens if they're claiming depreciation when they come to the end of that? What happens to the capital gains tax?
Yeah, so there's a little two parts to that question, I guess, is the fact that they've realised that it was their principal residence, it's now rented out, so it's no longer their principal residence. But it's, before you even answer that question, I suppose they've got to be aware of the 6-year rule. So long as they've got no other principal residence, that property would continue to be exempt as a principal residence for up to 6 years if they're claiming tax deductions on it, and effectively forever if no one's living in it. So you've got to start back at the principal residence rules to really understand that. And if it's going to be exempt as principal residence, then all these other questions become somewhat academic. Now, assuming that it isn't going to qualify as a principal residence, then you've got to remember any claims that you make for these construction allowances, which is one of Brad's reports would allow you to do, need to be added back to the cost base when you do finally sell the property.
And Ian, can we just clarify for everyone listening to this that a lot of people mistake and believe that when you claim depreciation you have to pay it back, but you don't. It adjusts the cost base, so it ends up only being a small portion of it essentially that's paid back. It's still worthwhile claiming it along the way.
Oh, absolutely. I don't think there'd be anyone suggesting that. I can't think of a situation where it wouldn't be worthwhile claiming it along the way.
I also heard that if you know that there's depreciation that can be claimed on a property and you choose not to, the tax office will treat you as if you have anyway.
Yeah,
if you're aware of it, then you must claim it.
I've heard about the stories about things like that, but really, I mean, what's the point? You're entitled to claim it.
Why not?
Why wouldn't you?
Absolutely.
So, you know, those issues become somewhat academic, and we can enjoy that over a quiet drink one day. But to me, you'd claim it. It's a deduction, and it's irrelevant to some degree. But the main thing about the construction allowance claims is that, you know, as Brad has pointed out to us today, you're obtaining deductions on those now at your marginal tax rates, and the add back is when you sell it with the 50% discount employed as well. So there's a major difference in the calculation and also the time value of money. And as we pointed out earlier today, capital gains tax is the easiest tax to not pay. Just don't sell. So
excellent. Okay, thank you. Felicity, I believe you have a question for us about when to sell. Do you have a microphone there with you?
Yeah, today there's been quite a lot of information around managing the realisation of capital gains and holding property long term, like Ian's just indicated. How do you know then when to sell an initial property investment that's had good capital growth to enable the purchase of, say, 2 new properties where the prospects of growth look strong or stronger?
This is a really good one, Lisa, and it's one that we often get asked on the show. You know, should you sell a property, and if so, when?
I think that there's a couple of answers to this question, and I guess one of the answers is that if you don't have to sell it, as Ian's indicated, then why would you sell it? I guess the suggestion might be to leverage out of the equity that you've got in that property to then go and buy another one, as we've indicated in many of the things that we've said today. So leverage the growth that it's had, get into another property and keep it, because it could still continue to grow in the future.
And I guess one of the important things to note there is that unrealised gain is worth more to you than realised gain. The minute you realise it, you lose a portion of it to capital gains tax. If it's unrealised, the whole gain is there to be leveraged against. And for me, the only time I would sell a property is if I got to the point where the bank said, we're not going to lend you any more money, and my opportunity to get into another property in a great area is removed from me, and then I might look and see if there are properties that I could maybe liquidate if I think they can't do anything more for me and I've already gotten some great gain out of that. And even then, I'd still do it under the advice of my accountant to be sure that my capital gains tax liability wasn't so big that it became a nil-sum game doing so, especially with the buying and selling costs that are also involved. Okay, we've quickly got time for just one more of our written questions before we need to go to another break. And this one comes from Richard, and this one's one that I want to ask you, Andrew. I think it's one that's really right up your alley.
Right up my alley.
Right up your alley.
Scary, Margaret.
Not a good place to have a question, but...
We won't go there.
Richard has said, with the fall in the Oz dollar to around 70 cents or 70 US cents, do you feel that Australians will now holiday at home? And if that's the case, does that mean we're going to be seeing growth in places like the Gold Coast and the Sunshine Coast and, you know, Cairns and those holiday areas?
Well, absolutely. And it won't be just us holidaying at home. It'll be the international tourists coming here as well, because it's a win-win.
So what happens in those property markets?
Well, we're already seeing Cairns a very strong market at the moment.
Thank goodness. I have been in that market for 15 years and I've gotten zero out of it.
Well, your dreams are about to be realised there, Margaret. Yeah.
See, what does it say? Good things come to he who waits.
Yes, get your hula hoop skirts and everything on, and it's all happening in Cairns at the moment, but not units. Houses are very strong.
Oh, thank you. I happen to own a unit.
But look, the other thing is the Gold Coast market as well. I think that we'll start to see that market, after particularly the unit market there being in a trough period for the last 3 or 4 years, perhaps a little longer, in reflection of that overbuilding that occurred 3 or 4, 5 or 6 years ago. I think we'll see that start to improve as well. I think that unit market may have bottomed out in the Gold Coast, and part of the equation will be increased tourism into that area. the Gold Coast remains an iconic holiday destination for Australians, and it will be getting a little bit less expensive in compared to Bali and Thailand and the usual suspects with a lower Australian dollar, yeah.
Now, just quickly, Andrew, on the Gold Coast,
Yes.
although the unit market has really been smashed,
Yep.
and certainly Broadbeach and Surfers have,
Yep.
there are some suburbs around the Gold Coast that haven't done too badly because it's almost like a two-speed market. The suburban market actually hasn't been smashed quite so badly.
No, it's the bookends, Coolangatta and Surfers Paradise, and particularly canal side property in the mid to higher price ranges. That's had a good pickup. The Gold Coast has actually had quite a good year the last year. So has the Sunshine Coast. Similar scenarios there. Value opportunities are being recognised by buyers. They're moving in. Prices haven't moved over the last 5 or 6 years. So that's creating some momentum. But look, I think that Gold Coast unit apartments, and I'm not spruiking this, have maybe just about reached the bottom of their cycle. And yields are quite good there as well. And there's also vacancy rates are quite low. So for investors, there's a good opportunity there. But it certainly was an oversupplied market, paid the price for a number of years, and maybe coming back into balance now. And a lower dollar will help that.
Excellent. Well, that's good news. I'm not convinced yet about the Gold Coast market, but hopefully...
Bottoming out.
Yeah, bottoming out, but that doesn't necessarily mean
bottoming out, yes.
Bottoming out. Absolutely agree with that. Well, thanks for tuning in. This is Your Money, Your Call, and we are in a special edition with 5 of my top experts and, of course, me here answering questions from a live studio audience. But time is marching on and we have to go for another break. We'll be back again very soon. Please don't turn over to another station. Stay right here and we will be back soon. Welcome back. I'm Margaret Lomas and you've tuned in to our special edition of Your Money, Your Call, where my 5 top experts, Lisa Montgomery from Lisa Knows Money, Andrew Wilson from Domain, Michael Teys from Block Strata, Brad B from BMT and Ian Rodrigues from Bishop Collins. They're all here answering questions in front of a live audience and they've been drilling them hard. So it's been a great night. Now, you can't call in and we're near the end of the show, but we have time left for a couple more questions here. So we're going to go back to the audience, and Ellis, you're waiting by, ready to go with the next question for our panel.
Yes, I have a question. If the mortgage on the PPOR that has a few lines of credits attached to it, it was used to leverage for the investment properties along the way. And for upgrading purposes, if I sell this property, to my knowledge, that means the bank will take the money to pay all of the money, the amount that owed first. That means I will left with not much. Okay. So is there any way to avoid this as I don't want to pay down my investment loan, and then it's also for upgrading to buy a new PPOR?
This one, Lisa, is a question that comes up often, and it's where an inexperienced investor who isn't seeking help from other people can get into trouble. You know, we've seen clients come into Destiny where they've sold a property, the bank's just applied the money willy-nilly to one of the accounts without checking back with the borrower. Suddenly that gets them in a very bad tax position. They can't go and shuffle it around. The tax office isn't going to allow that. You've got to be careful about how debt is repaid if you're only getting rid of a small part of your portfolio where everything's tied up.
Yeah, you've got an issue with this one, and I really think that you will need to seek the good advice of your accountant on this one, absolutely. One way you may be able to go about this is to refinance that debt using the investment properties as security, and sometimes you might find that the loans are portable and that they are able to be moved over to different security. And then if you can show the trail of that and obviously establish that the purpose was always for investment property finance, then you might be okay. But I really do think you need to seek the advice of a specialist on this one. And Margaret's absolutely right. You know, you would never set it up that way. if you knew that you were going to sell that property and upgrade into another PPOR. It's very, very important that, you know, that you would have known that before, which is what I think we talk about quite a bit, is to start to think about what is right for you now and also what's going to be right for you in the future when you do make those decisions.
Now, I'm going to give you a strategy, actually, that you can help, and that means that it's not necessarily such a big mistake. But did you want to make a quick comment first, Ian, on this whole structure?
Yeah, look, it's a common problem that comes up. Is, but you remember with tax deductibility, it's always use of money. So whatever you use the money for, not what secured it. You've got to work together hand in hand with the bankers here. They're happy. They want their money back, because if you've sold the thing that secured the loan, you can't take the money and do the runner. But they can hold it in a term deposit or something like that and keep the facility in place, keep the security going, because it's a temporary transition. So if you're talking to your bank or your mortgage advisor and things like that, it definitely can be worked around. The biggest risk, I think, is what's said, is no one tells them, so they just do what they think's the right thing and pay off a loan that you didn't want paid off. They should ask you, but sometimes you don't even know the answer to that.
It's about the trail and how you establish that, so the tax office is actually happy at the end of the day.
And thank you for that, Ian, and that's definitely the solution I was going to suggest to you. If you're getting rid of your own home but replacing it with another own home, then the money that you get out of the sale of your own home can simply sit as a term deposit to secure that part of the debt if you want it to, and it's dollar for dollar. So it works very, very well. I've done it myself a number of times where I've wanted to get rid of a property but I've wanted to keep the whole facility in place, just secure it with a term deposit. The banks don't love it, but they will do it, providing they know it's for a limited period of time. OK, we're going to go to another question here, and this one's from Jeanette. Jeanette, if you'd like to ask the panel your next question, please.
Yes, hi. We have a DHA property which we're finally going to get control over in October, and I'm just wondering, because it's a townhouse, what we need to do strata-wise with the board of, you know, the people. And
OK, so can I ask you a couple of questions? Yeah. This particular property is obviously, townhouse is in a complex. Were they all DHA at the same time?
No, probably about 8 of the 25 to 30 were.
OK. All right, just to explain to everybody in the room and on sitting in their homes, if you don't know what DHA is, it is simply Defence Housing of Australia. They are properties that were sold under a rent guarantee scheme whereby people would buy them, then hand them over to the DHA, who would then charge a fee of around 16% to manage that, and they would rent it out to defence personnel. The deal is that at the end of the period, be it 8 years or 10 years, it's refurbished or brought back up to being nice again and handed back to the owner. Michael, my understanding of these, and you may know differently, is that they still have normal strata in place. Everything remains the same. There's probably not going to be any difference.
Well, perhaps not.
Okay.
If there's 8 properties out of 20, they've had a controlling interest or a substantial interest in the owner's corporation, and it would be worth your while to have an inspection done to see whether or not they've properly funded the sinking fund. Now, when we belong to an owner's corporation, we have obligations to progressively save for the replacement of capital items, and that's paid by the owners of the day to the sinking fund. Now, what you'll want to do is make sure that the DHA, as a significant owner of property, has funded that appropriately.
They're not the owner, though. DHA is not the owner. You're the owner of the property, and they're just managing it for you.
But DHA's probably had obligations, if it's a triple net lease, if it's been a lease to look after the property, they've probably had obligations in respect of the strata as well.
Okay,
they've
great.
probably had voting rights in respect of the strata under the terms of the lease, and that's where they will have used their voting power, and hopefully they've used it properly. But that's what you've got to check. The other thing I would say while I've got the microphone is you also should have a look at your lease, because the DHA lease is quite a commercial, it looks more like a commercial lease than it does a residential lease. I would have a depreciation consultant have a look at it from an exit strategy point of view, go through all of the covenants in the lease and make sure that you're getting the right fee on your way out. And people in commercial leasing know about that. The exit fee is a bonus for owners, and it's terrible for tenants. Make sure in this particular case that you get that done as well. It'd be worth spending some money to get a report done. I'm sure you would get many times back more than your fee.
That's great advice. Now, you may not know the answer to this, Andrew, but I'm going to ask you the question anyway. Have you had any experience or done any stats on DHA property and whether a DHA property performs the same as any other property in that area?
I was going to ask the question of where your property. Where is it?
Castle Hill.
Castle Hill. Oh, you know, that's rivers of gold.
Asked and answered.
Yes, gee. Look, as we were talking about market interference before from governments, one of the things we've seen with NRAS and DHS properties in particular areas is it can oversupply an area. I'm thinking particularly of Townsville here. There are significant issues in the Townsville market through National Rental Scheme, NRAS housing, as well as DHS housing, because it does create an underlying bonus or a subsidy for housing in an area, and that the private owners there have certainly had some issues in terms of trying to find a tenant. And also the type of tenant that does move into those areas. So, look, it is one of those stories of market interference, which can have some short-term imbalances. And Townsville's a market that, looking a little better now, but certainly has suffered through those NRAS and DHS housing.
Excellent. Bob, we've just got time for your question. If you'd like to ask that question of the panel, we'll see if we can get that answered for you.
Thank you. Actually, my question is about strata, and this is for leaking shower. So if water seeps through the grout and comes into the hallway, is that the responsibility of strata to fix it, or the owner?
Yes.
The reason I'm asking is a friend of mine actually, his strata fixed it recently. This is in Liverpool, so whereas my strata doesn't want to fix it. So that's why I'm asking. Thank you.
Go, Michael.
So it is a strata problem. Showers are one of those unusual things that is the responsibility of the owner's corporation, not the owner, even though it intrudes into the space that you would otherwise own. So it is strata property, and as strata property, the owner's corporation has got a responsibility to keep it properly repaired and maintained. So the minute it leaks, it's not being properly kept and maintained, and the damage that causes you as a lot owner will be damages that you can recover, from the owner's corporation. Now, your strata is probably saying it's because our insurance policy doesn't cover the carpet is the reason why they won't be responding to your claim. But that's not the answer. The answer is it's the owner's corporation's property that's caused the damage, so the owner's corporation's responsible. Whether or not it's insured for that is another question, and this is where strata managers who don't know the legal answer will mislead people all the time, and it's why you see that being treated differently in different places all the time. It's not about the insurance, it's about liability for the damage.
That's a fabulous answer, but you know, we've run out of time for this week. Don't worry, I'll be back again next week with our regular programming, and joining me then will be Brad Beer from BMT, just like he did today, and real estate author Peter O'Malley. I'd like to thank my special guest this evening, Lisa Montgomery from Lisa Knows Money, Michael Teys from Block Strata, Andrew Wilson from Domain Group, Ian Rodrigues from Bishop Collins, and Brad Beer from BMT. They've done a fabulous job. They've been here with me all day today, and we've had a fabulous day at our Sydney Property Intensive. If you're watching and you'd like to join into that event in Melbourne, we're on April 19 down there in Melbourne at the Melbourne Olympic Centre. Please go to our website, yourpropertyteam.com.au, yourpropertyteam.com.au to find out more about that. You can follow me on Twitter, Margaret Lomas AU, and also on Facebook. Go to my website, destiny.com.au, to sign up for my free newsletter. Thank you so much for being here for this special edition. We'll see you all again next week.
cash rate for the next announcement. This was also the last time the cash rate moved. It dropped by 0.25 of a percentage point. 60% of the panellists, 18 out of the 30, are expecting the central bank to announce a cash rate change this year, half of which are expecting the change as early as the first quarter. This is a huge jump from last month, when just 3 of those panellists expected the cash rate to move in the first quarter of 2015. The experts are split on the direction that the cash rate will move this year. However, with 14 expecting the next cash rate change to be a drop, the remaining 16 experts are forecasting the next